What's up guys, welcome back to DCA. So what we're going to do in this video is take a look at the USDT and USDC market cap dominance. You have to first think about what is this metric saying? Why is this metric important in the first place? And when we look at USDT and USDC, these are the two most popular stablecoins. And we know that what do stablecoins do for the cryptocurrency market? And they essentially add liquidity into the market. They make it so that individuals can quickly transact on DeFi protocols or go from exchange to exchange or go to decentralized exchanges. They allow us to essentially put our money wherever we want it to be in the cryptocurrency market instantly. And when you're using cash, you simply can't do that. So they have overall massively increased the liquidity of the cryptocurrency market. And what you can see is that, if we go back to 2018, the market cap of stablecoins at the time was, on the order of $4 billion or so. So the market cap dominance of these stablecoins has just massively increased. So now the market caps of USDT and USDC, for instance, is right in the neighborhood of right at around 125 billion at the moment, plus or minus a few billion. Okay, so we've seen it increase in size by orders of magnitude over the last few years. So what is interesting about this is when we look at this oscillation of the market cap dominance between USDT and USDC, something plays out in the crypto market every time that we come up to this upper band and every time we come down to this lower band. So let's start by looking at times when we've come up to this upper band, because that's what we're doing right now. And we see that, back here in February of 2019, and we have numerous other instances of this, like here in March of 2020. And then we can see this happened again, the upper band here in September of 2020. And then here in July of 2021. And now yet again, right here. Okay, so right here in July of 2022, almost a year from the last time that we last came up to this upper band. Now notice that we didn't quite get there in July of 2021, but it was close enough. We were within 1% or so of coming up to that band. So one interesting thing that we see is every time that we come up to this upper end of this band, so you could think of this as a resistance level, each time we get up to that level, we see a large market turnaround. So, if we just take a sample of what type of price moves we've seen in the past when we've come up to this level. So, the total crypto market went up around 145% at that point. Obviously, right here, we had this bull market in 2020 leading into 2021. So, this was almost two events here. But the first move was around 120%. The second was around 378%. All right. And now we're sitting right here. We've hit this upper band. And so far, we are up 21%. So it's kind of, thus far anyway, playing out a very similar pattern to what we've seen it play out like in each prior instance when we've moved up to this band. So why is it then that we see this odd dynamic where the stablecoin dominance, when it's at this resistance level that's been increasing, and do note that it's been increasing, and that's important. You see that we've been on this upward trend now, basically for 2 to 3 years. And I think the reason is because of the fact that this is essentially a measure of liquidity in the market against the total value of the cryptocurrency market. And so as we see the liquidity in the market build up, we see this build up over time. When we get up to this level, that indicates to the market, either directly or indirectly, that the total crypto market is at a discount. And when it's at a discount, individuals are going to start to buy assets. They're going to start to buy assets that they believe in, very likely that they believe have long-term potential. What we're saying is that as the liquidity builds up against the value of the cryptocurrency market, that signals to investors that the market is at a discount, and we typically see then people utilize those funds that are sitting on the sideline and they start to pick up projects that they believe have long-term potential. And now conversely, let's look at the other end of the spectrum here. So we have times like here in 2019 when the market topped out right here in June of 2019, and then we went on this prolonged bear market. So just like we show that the market does quite well in every instance where we hit this upper end of the band, how does the market do when we hit the lower end of the band? In other words, the stable coins sitting on the sideline are very little in relation to the total cryptocurrency market. And so people then want to take profits, build their cash reserves. And so you see them converting the cryptocurrency into stablecoins because they believe that the cryptocurrency market is priced at a premium rather than a discount. And so we've seen a big market correction in each instance. So you see we had a 45% correction, and that's not including the COVID capitulation event. And then when are other times where we've hit this lower end of the band? Well, right before COVID. Right before COVID, we hit this band, and then we dropped around 50%. Then again here, during this bull run, we actually were able to ride in that price premium range for quite some time. But what happened? We all know the price then crashed. The market crashed. So we saw a 42% correction in the market. Okay. And then, again here in November, we hit that bottom end of the band, indicating that the market is at a price premium in relation to the amount of liquidity sitting on the sidelines. And what happens? We all know what happens. Massive correction. So the total market is now down around 62%. Okay. So in each of these instances, you're essentially seeing the dynamic play out between how investors value the asset class and how they're looking at it as either being at a premium or at a discount with relation to the amount of liquidity sitting on the sidelines. So, what are we saying here? What's the overall thing that we're trying to get at? Because, when we talked about this metric a few weeks ago, I mentioned the fact that based on all of the macro events playing out right now, I was concerned that we would finally break this trend. And now remember, breaking this trend is not a good thing because that means the market is dropping in value as the stablecoin sitting on the sidelines are building up in relation to that value of the cryptocurrency market. And well, so far anyway, we haven't seen it play out like that. We have not seen the market rally past this level. So up until now, it looks like this is playing out exactly like we've seen it in the past. You see that we hit this upper level, we got rejected off of it, and now we're heading down. And remember, in this case, heading down is a good thing for the market because that means the price is heading up. Okay, so this is going to be an important metric to watch. I really do think that this is probably going to be one of the more important metrics. The reasons that a metric like this makes a lot of sense is because it's showing you the dynamics and the way that liquidity in relation to the perceived valuation or the perceived value of the cryptocurrency market at any given time. It's showing you where that interplay is at. And so I think that this is a very important metric, and it's definitely one that we'll need to continue to watch. So thus far, my prediction that we would very likely head above this hasn't played out, but we've also seen the stock market rally at the same time. So we'll have to see how it goes going forward. And I'm still going to hold to what I said in the last video, and that's that, if the market sort of makes a downturn, and we're talking about the general market, if further bad news comes out, if inflation, the next readings, if they come out high again, if we're still setting new all-time highs or, new 40-year highs, if that happens again, and if we're continuing to see the Fed take a hawkish tone, I do think eventually it's going to be hard for this to continue to trend down. But, with that said, this is why I think right now, the whole thing that we're seeing play out in the market where people are talking about, FOMOing in right now, I think this is why we've been talking about dollar cost averaging into the market, into projects with strong fundamentals for months and months and months now. We've been dollar cost averaging in for months at this point. And so there's no reason to FOMO for us, for people who have been dollar cost averaging in, because we've been taking a a steady approach to the cryptocurrency market, just like we did back in 2018. And, just like we're going to continue to do again in this cycle, because we've seen moves like this all the time in the cryptocurrency market. These big moves to the upside. Recall that back here, when Bitcoin was initially down at right at around $30,000, it went up to 48K, right? So we see these big moves in the market all the time. But we also know that we often see them as major fakeouts where we'll get a nice rally, people start to FOMO in, and right when it looks like that the market is really about to take off, the rug gets pulled out from under you. So we're not going to get too excited about this. We're not going to, FOMO into the market. We're going to continue to take a measured approach, dollar cost averaging, picking our spots, buying Bitcoin, Ethereum, and other top altcoins, in certain locations. And it's just a way that you can take control of the crypto market rather than letting it take control of you. So that's going to be it for this one, guys. Until next time, as usual, see you.